This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion.
As we approach the weekend, let me jump in with a little bit of a mini best of episode. John Gordon, author, very motivational guy. Andrew Lo, MIT finance guy. Yeah, they come from a different perspective, but I like their combination. I like grouping them together today. Now, before we go jump in, I want to remind everybody, in this day and age of anger, hostility, rage, victimhood, all these negative things, especially rolling across America, my home country, these things, by and large, are in your mind. Now, of course, I just triggered probably 50% of the population, but hear me out for a second. A lot of these things unfolding right now are not going to change. I mean, not the way that you might imagine them changing. So what do you have control over? You got control over you. And that's it. You can't control your neighbor. You can't make your neighbor like you. Hell, you can't make your family like you, perhaps. But you can wake up every day and you can control you. You can do something with you. That's what you can do. Or you can bitch and complain and blame everybody for the rest of your fucking miserable life. Now let me put a happy face on it. I don't want to do that. Who really wants to do that? And hell, if those kinds of people are listening to this show and I haven't converted them, what the hell's wrong with them? They're in some kind of massive cognitive dissonance. If they hate life and they're listening to me, what the hell's gone wrong with them? So in the midst of our crazy world of pandemics and riots and looting and arson and killing and all this other crazy stuff, the world has been going on for a long time. It will be going on for a long time after us. So damn it, wake up each day and make something happen. That's all you got. The rest of it's all just bullshit. Without any further delay, let me jump right into John Gordon and Andrew Lo. I hope you enjoy.
My guest today is Andrew Lo, professor of finance at the MIT Sloan School of Management. Andrew has a great perspective on many of the subjects near and dear to me. His newest work, Adaptive Markets, Financial Evolution at the Speed of Thought. You must read this book. Look, the efficient market hypothesis, come on, give me a break. You know in your heart of hearts it's not useful. Andrew digs in deep to present an alternative way of thinking. And I got to tell you, this is where we should all be going. I hope you enjoy this conversation with Andrew Lo. So Andrew, the first time I saw your name, I want to say it was in a transcript. It was in a transcript, and I believe it was called the Greenwich Roundtable. All these great hedge fund manager names, Jim Simons, Toby Crable, Ken Tropin, all these guys that are seemingly with their work showing there's a problem with the efficient market hypothesis. And that was where I first saw your name was in those. And those are some great transcripts. I don't even know if they're available, but they're fantastic information in those transcripts. But let me take you back in time a little bit. I know and I've seen you talk about being in an event, the National Bureau of Economic Research, at an event in 1986. And you talk about there, and I'll let you explain too, but you talk about that your results were not accepted so quickly, so to speak. But even go back before 1986. Give me the starting point where you started to think to yourself, there's a problem with one of the most important precepts in finance and the efficient market hypothesis. Give me that foundation and some of those early experiences where you started to question things.
Sure. Well, it was an interesting time because I grew up in the tradition of efficient markets. And as a grad student, I was taught by a number of faculty that really the efficient markets hypothesis was gospel truth. And so I took it to be gospel truth. I certainly didn't have any reason to doubt it. But the thing that got me started down another path was the fact that I enjoy dealing with data and looking at numbers. As part of my research, right after I graduated, I decided to take a test of the efficient markets hypothesis by focusing on the random walk. Really, the idea wasn't to reject the random walk. It was just to come up with an interesting statistical tool. That was my ambition. And together with my co-author, Craig McKinley, we designed this statistical method that used a very specific property of random walks, the idea of a drunkard's walk. Can't predict where a drunk will go. If you apply that to this notion of the stock market following a random walk, it turns out that you can construct a very simple test using ratios of variances. And we thought we had come up with a pretty neat statistical test and wanted to try it out. So we just decided to apply it to the U.S. stock market. We were shocked to learn that according to our test, the stock market did not follow random walks. At first we didn't believe it because, well, we were taught in grad school that markets were unpredictable because of this notion of efficiency and randomness. And it really took us probably a good 10 years of various kinds of additional tests, refinements, and various kinds of counterfactuals that we had to rule out, that ultimately I came to the very uncomfortable conclusion that the random walk hypothesis was actually false.
What's really interesting about some of your writings is you are pretty open about academia in the sense the competition and how difficult it is to be an outsider to get a view across. When you and Craig first started to have those aha moments, give me a sense of that feeling of looking at each other. I mean, was it one of those kind of things where you're both, young guys and you have this experience, you've done all this work? I mean, what was the emotion in the room? I mean, were you excited? Were you scared? I mean, what were you feeling?
Well, when we first came upon the result, we actually thought we made a programming error. So we had to go back and redo the calculations. And I remember very distinctly that Craig and I each replicated the calculations separately on our own, using our own software, and ultimately coming to the exact same conclusion. So we checked our results quite a few times before we ultimately came to the very uncomfortable conclusion that, the data really doesn't comport with this theory. So I think initially it was really disbelief, and then eventually it became a kind of a grudging acceptance that there's this inconsistency. And then for several years after, we tried to explain it away. We explained it away, we thought, with various kinds of anomalies. And one by one, as we looked at those anomalies, whether it was trading costs or asynchronous trading or various other kinds of, explanations that really had to do with the details of market microstructure, we couldn't explain it away, and eventually came to that conclusion that, in fact, the theory didn't fit. But it was a difficult process for us because, we were really raised in that kind of an environment. I ultimately, had to come to the conclusion that what we were taught wasn't true.
Were there early experiences with other academics or even people on Wall Street where you, we're going to end up going down the path of your newest book, Adaptive Markets, but in the early stages, when you started to talk to people about your work and what you had found, were the reactions, I'm expecting there were some reactions where just go away. I mean, what was the, I mean, I saw the note about the MBER event, but speak to me about if anything comes to mind about an early conflict, perhaps.
Well, so certainly when we showed our colleagues the results, before even presenting it in a conference setting, our colleagues thought that we had made an error, and they just didn't buy it. So that's what prompted us to go back and redo our calculations. And then when we presented it at this conference with a number of our peers, they also didn't believe it. We were really, kind of taken aback. That was our very first academic conference, and we hadn't realized that there could be such controversy. We never expected to be part of that controversy. Over time, it became clear that we hadn't made a programming error, and the data really did show that the random walk wasn't consistent with market data. But it took a while to get there. And at that point, once you acknowledge the fact that the data weren't wrong, you had all sorts of uncomfortable questions that you had to deal with in terms of the consequences. And so we spent a fair bit of our early years as assistant professors working out those implications.
And that's the early foundation as we kind of bring it up to current day and your work, adaptive markets, and your hypothesis, your theory. Why don't I let you, from a big picture, the 35,000 foot look down? I can see, and I relate to so many things that you write about. They just, you can feel, okay, here's the influence of Daniel Kahneman coming in. Here's where these guys, here's where you have gone down the path to see that the efficient market hypothesis is not accurate. But what I like about the kind of big picture view, and I want you to run with this, is that this is more about, from your perspective, not viewing everything as a well-oiled machine that's just perfect. It's more about biology. It's more about evolution. Why don't I let you give your big picture view to the audience?
Well, economists have this view of the world that is very much driven by the model that physicists have developed. I often say that economists have physics envy because we wish we had three laws that explain 99% of all observable phenomenon the way physicists do. In fact, economists can't explain more than 5 or 10% of all observable phenomenon with 99 laws that we come up with on various different occasions. And it's terribly frustrating because we are fundamentally dealing with more difficult problems. I think Richard Feynman, the great physicist, said it best when he said, imagine how much harder physics would be if electrons had feelings. And, clearly we understand that the world is a much more complicated place because of human behavior. The idea behind the adaptive markets hypothesis is really to try to change that worldview, to change the view that economists have gotten used to of using mathematics the way physics uses mathematics. In other words, to try to model mechanistic systems that don't change over time and have these immutable fundamental laws, to a world of biological phenomenon where what we're dealing with are different species that are interacting with each other, and that it's really the laws of evolution, mutation, selection, and ultimately adaptation to various different changes in the environment and to various species that drive market dynamics. So that's really what the adaptive markets hypothesis is. It's just taking the basic principles of evolution and applying them to financial market transactions and dynamics.
It sort of seems intuitive, maybe from the catbird seat of experience now, but it seems intuitive that when you look at some of the behavior, for example, we'll give the audience some color and think of some events going back to 1973, 74. You can think of 1987. You can think of the dot-com bubble. You can think of the Great Recession. None of these events, conform to any kind of precise model. They just look emotional.
I think it is intuitive, but really from the perspective of investment professionals. Given your background and your experience, you've seen a lot of these non-stationarities and punctuated equilibrium events where markets can change dramatically over the course of just a few months or a few years, and they look nothing like the kinds of mechanistic explanations that mathematical economists like to use. But people who are steeped in the theory, namely academic economists, they get very wedded to their ideas. And so, part of the process of coming to the adaptive markets hypothesis was a bit of self-examination about how we as economists engage in research and dialogue with each other, the kind of mindset that we all have, and almost the sociology of our field has been part of the process of really understanding how it is that for so long we haven't come to terms with the fact that there are these disparities between our theories and the various different data that are out there.
There's the cross-discipline aspect here, too. If you look at it, you're kind of like, okay, this very bright MIT finance professor, economist, is in the middle of dissecting financial theories, but at the root of that is thinking about things like sustained emotional stress just keeps us human beings from making rational decisions. It's a really cross-discipline to where you've gone in your work. Do you feel like that sometimes you kind of think to yourself, wow, I'm going in much different directions than perhaps I thought I was going to go when I first started my career?
Absolutely. I certainly had no intention of cutting across these various different disciplines. When I first started out, I was perfectly happy as a card-carrying economist focused on all sorts of phenomenon that you would expect a good financial economist to think about. Derivatives pricing, risk management, investment theory, all of these ideas were really squarely in the domain of financial economics. What ultimately led me to these various different fields was the fact that the data that we were using to try to explain these theories just didn't fit. I wanted to understand why they didn't fit. I wanted to trace the origin of these discrepancies. And I guess as an academic, we're trained to be pretty stubborn in terms of trying to get to the bottom of things. I started by trying to understand the behavioral literature that emerged in the 1980s and 90s by psychologists and behavioral economists. I couldn't make sense of these anomalies because while they developed all of these different anomalies, they didn't explain why they were there or when one anomaly would be appropriate versus another. And so from the behavioral finance literature, I went to the psychology literature to try to see if the answer was there. And the psychologists didn't give any answers. They had many, many different theories that were, in many cases, mutually inconsistent. So then I went from the psychology literature to the neuroscience literature, because after all, behavior is ultimately generated by the brain. And from neuroscience to evolutionary biology and to ecology. And it was really just continuing my search for an understanding of how to reconcile the various different views of financial markets that brought me through all of these various different disciplines.
Even though you have put this work together that strikes at the heart of so many financial careers, you don't write in a way where you're not trying to hurt anybody, so to speak. You're trying to get to the truth the best that you can, seeing that there is these inconsistencies clearly exist. I'm just wondering, though, as you've been working on your book for the last couple of years, and it's come out most recently, you must have smiled, I'm guessing, when the Nobel Committee handed out prizes to Fama and Schiller in the same year. That must have caused you to kind of go, wow, they're kind of setting the foundation for, giving me a foundation to push off from. How did you feel about when that was announced?
Well, that's exactly right. I was delighted by that choice, and not just the two, but all three. Having Gene Fama, Bob Schiller, and Lars Hansen win the Nobel Prize, all for their work in finance in the same year, was, I think, absolutely inspired. And I couldn't be more pleased with how the Nobel Prize Committee formulated their choices. And I knew that there was a bit of a sense of humor and kind of an impish, mischievous humor in the Nobel Selection Committee's choices, because in the past, this has happened before, where in certain cases, they would select economists that had diametrically opposing views in the same year, almost to underscore both the importance and relevance of each of the theories, but the fact that it's still a work in progress and that we don't have all the answers yet. And I think that's exactly what they did when Fama, Schiller, and Hansen won. My interpretation of the three choices was, markets are efficient, except when they're not, and quantitative methods can help us to distinguish between the two. Those exactly are the three choices that they made. And you're right, it does set the stage for trying to reconcile these various different perspectives.
It's like giving carte blanche to say to the academic community, to Wall Street, do you have a way to, as you just mentioned, do you have a way to settle this? What are people thinking? It was almost a challenge issued.
There are different reactions of those set of choices. I think that one reaction that I've heard is that, well, this is clearly confirmation that economics is not a science if you can have two people who win the Nobel Prize in the same year saying the opposite things. And so I've heard that on a few occasions, but I think that that's a relatively uninformed view of economics. I think that more and more economists are coming around to my view, which is that it was a very inspired choice because it highlighted both the value of each of these schools of thought, but also the fact that we're not done yet, that there's still some very important kinds of reconciliation that needs to be done among the various different perspectives.
Let me take you back in time a little bit as we build out here. We start this conversation with the early 80s, your first presentation, 1986. I would like for you to go back and kind of give me a feeling of how your thoughts were developing when, for example, October of 87 hit, when the dot-com bubble burst, and when the Great Recession happened. Give me an idea of where you were at each one of those events in terms of your thinking and how each one of those events affected you, if not perhaps even just kept giving you more confirmation that you were on the right direction.
It was really the confirmation perspective that I think characterized those phenomena. Efficient markets hypothesis disciples would argue that prices fully reflect all available information. And so you would not expect there to be tremendously large price movements unless there was some kind of external shock. And October 87, nobody could really identify any kind of external shock that caused this massive crash. It wasn't as if there was some outside event or political disaster or a threat of war. It was just really an extraordinary change in the fundamentals of market valuation. That suggests that either the valuations on the previous week were way overinflated and now we're at the correct price, or it would have said that the prices today were clearly irrational and too low relative to what they ought to be last week. But you can't have it both ways. And so that was sort of the beginning of my sense that we really need a different narrative. And what that narrative is was a mystery at the time. It was something that I was groping at. One series of events after another started bringing more and more light onto the particular problem. It was really in 1999 that I think I finally started putting all the pieces together. This was, after LTCM, as well as the 87 crash, as well as a number of events in the market that really called into question, how people behaved. In 1999, I remember a very fateful trip to the zoo, the Washington, D.C., the National Zoo. I read about in the book where I was visiting the gorilla house because my son was just an absolute fan of gorillas, since one of his favorite books when he was growing up was Good Night Gorilla. At that time, 1999, he was 4 years old. So we went to the Great Ape House, and there was an outdoor exhibit with the gorillas. And I remember very clearly my son standing next to me. We were just beyond the reach, of a very, very adorable baby gorilla who was sticking his arms out for some peanuts. My son approached that baby a little too quickly to give him peanuts. The mother gorilla immediately came over and grunted and was, quite threatened by my son's actions. As soon as that mother went to interpose herself between my son and her child, I immediately jumped in and grabbed my son and pulled him away. And at that moment, I realized that my actions and the gorilla's actions were not that different. That we were actually wired in the exact same way, and we reacted instinctively to protect our young. And that got me to thinking that the same kinds of explanations that we propose for animal behavior, that should apply to Homo sapiens as well. We are, after all, another species of animal. We may be more sophisticated. We may have more complex kinds of opportunities to change our behavior, but nonetheless, we share some very important circuitry. So that was sort of the beginning of the adaptive markets hypothesis making itself clear to me and how it fit in with all of the various different existing theories that we were developing.
Bring yourself up to 2007, because as a professor at MIT with your specialties, summer of 2007 got quite chaotic. And then, of course, coming into the fall 2008, October 2008, give me some perspective, perhaps some feeling about, again, it could have just been more confirmation that you were on the right path. But did something come out of the Great Recession that added to your perspective even more?
Well, it did. And it actually started in 2005. So in 2005, I wrote an article. Actually, the article was first presented at a conference in October of 2004. It was an article that looked at the notion of systemic risk, the idea that the entire financial system could be at risk. The motivation for that was, of course, what happened several years before, 1998, LTCM, the fact that a hedge fund could create these kinds of shockwaves that ultimately threatened the financial stability of the entire financial system was really quite an extraordinary event. And so I spent a fair bit of time studying that leading up to 2004. Well, one of the things that my students and I discovered when we looked at the data on hedge funds is that from a variety of different statistical measures, we were seeing a buildup of leverage and illiquidity in the hedge fund space. And because we saw the impact of hedge funds.
What style were you guys looking at that time? What type of style of hedge fund?
Well, we were looking at all different styles. So the data that we had was from TAS, the hedge fund database, where they provided individual hedge fund returns across various different kinds of strategies. So we actually broke them down by 11 different categories that ran from managed futures and trend following all the way to convertible bond arbitrage, emerging market debt, and so on. And so we looked at each of these different categories. The category that we found the most interesting was fixed income arbitrage. Fixed income arbitrage was the category that was involved in the LTCM debacle. And what we noticed leading up to 2004 was that that particular family of strategies was becoming more popular, was raising more assets, was becoming more and more illiquid using this illiquidity measure that we had come up with a few years before. We had a series of statistical models, factor-based models, to try to understand the risks in the hedge fund industry. And what we were finding, not just in that particular strategy category, but across all the categories, we noticed that assets were growing and the kinds of factor exposures, the commonalities among these hedge fund strategies, they were also growing, and that the correlations among these strategies, which were supposed to be relatively uncorrelated and great sources of diversification, we noticed that actually they were becoming much more highly correlated. All of this going into the end of 2004, and that's when we presented our results at a conference. We pointed out that hedge funds were becoming a much more important source of systemic risk, and that there was a a concern of ours that we were going to see a repeat of 1998, but on a much larger scale. And so we first presented it in October of 2004, and the paper we ultimately wrote and circulated caught the attention of a New York Times reporter in September of 2005. In one of the issues, I think it was the Sunday Times, one of the Sundays in September, he actually wrote about our paper, and the last paragraph was that the nightmare scenario that we were looking at was one of the hedge funds blowing up and bringing down one of the broker-dealers that lend to them. When that article came out, we were roundly ridiculed by former students and colleagues on Wall Street because they thought that it would be impossible for a hedge fund collapse to bring down a major bank or broker-dealer. That was in September of 2005. And of course, just a couple of years later was Bear Stearns, which was brought down by their hedge fund strategy, and the same with Lehman Brothers a year later. When the financial crisis hit, we had already been talking about it, and back in October of 2004, and then ultimately May of 2005 was when the first salvo was realized. May of 2005 was when General Motors downgraded their debt. And if you remember that time, that month, a number of convertible bond arbitrage managers all lost money at the same time. So that was one example of the so-called crowded trade phenomenon. And between 2005 and 2008, a series of crowded trades blew up one after the other. And that's basically what we had written about back in October of the previous year.
At that time, you were accessing data from TASS. Did you have access to data, or did you know the full scope of the trading activities inside the then four largest major investment banks?
We did not. In fact, one of the things that we had no clue about was what was going on in subprime mortgages. People have been talking about it, and there were a number of red flags that were being raised by various different pundits, including Bob Schiller and Raghu Rajan. But our focus was really on hedge funds and the data that we had access to. We didn't realize that what we were looking at was just part of a much, much bigger problem, and that the hedge fund industry ended up being the canary in the coal mine. They're the first to get hit. So as an early warning sign, the hedge fund industry plays an invaluable role in allowing us to understand what's going on with financial markets. And it wasn't until a year or two later, after all of these various different losses started piling up, that we began to put the pieces together.
Do you ever allow yourself, and I'm not asking for any kind of forecast or anything like that, but when we're at all-time highs, everything is just going swimmingly, there's got to be something in the back of your mind that says, what do I not know?
I think that we are heading towards a major dislocation. And I think part of the reason that you can tell this is the direction we're heading has to do with the combination of volatility in the stock market, the fact that it's near all-time lows if you take a look at an indicator like the VIX. But then when you take a look at various other measures like skewness, kurtosis, the volatility of volatility, these measures are all pointing towards some kind of a major event that may be happening over the course of the next 6 to 12 months. And I think that definitely is something that is worth watching.
What's interesting is you say that too, and I want the audience to keep something in mind, is you're not attempting to say, some of these guys out there on assorted social media and whether, the finance channels making the daily prediction, you're more or less, you're looking at the data, you're saying, here are the extremes that we're seeing, and it's worth paying attention to these particular ratios given past historical situations.
Absolutely. I'm certainly no market pundit. I think Paul Samuelson said it best. He pointed out that economists predicted 5 out of the last 3 recessions. I think we want to be careful about making forecasts, but what gets me concerned and causes me to raise the red flag at this point is the fact that when observed volatility is low, the VIX being, what is observable right now, the implied volatility that market participants are using to price these various different instruments. what that suggests is that there's a complacency that investors have developed. When they feel that risk looks low, they will often start increasing the exposure to market securities and essentially bring their own personal portfolios up to the level of risk that they're comfortable with. If you're comfortable with 10% volatility and the market looks like it's half of that, you might be willing to take double the exposure. When the volatility goes down over time, investors start taking more and more risk, thinking that the risk in the underlying market instruments have gone down. But in fact, that may be a misperception. In fact, the risk may not have changed. It's just that there's a period of lower than average volatility, but it's likely to pop back up at a moment's notice. And I think when that happens, there are going to be some very, very rude awakenings. That's the kind of market disruption that I'm concerned about.
Hey, I would be amiss if I did not follow up. You mentioned Paul Samuelson, an early proponent of the efficient market hypothesis in an early form. That'd be a correct statement?
Absolutely.
And I think what's so interesting about him is he had this view, but then he also kind of had this really cool side gig called Commodities Corporation. And I
Right.
think that's so awesome, right? I mean, he was right there with a theory, trying to figure things out. But when it came to his money, he trusted the traders that he thought made the most sense for his money.
So I asked him about this. I was fortunate enough to be colleagues with him for a few years at MIT before he passed away. He was kind enough to invite me to lunch one day. And I asked him about this. I asked him about the origins of Commodity Corporation. He was very open about it and mentioned that when it first got started, the first year or two, they had used various different academic theories of supply and demand in order to try to make money in pork bellies and other commodities. They basically ended up losing money for the first year or so. And it wasn't until they brought on traders who were using technical analysis to trade that they started becoming profitable. This was a very, very strange situation for Samuelson to be in, because he obviously didn't believe in technical analysis, and yet, his portfolio was doing just fine. So he ultimately, I think, developed a different perspective, which is that there may be microeconomic efficiencies while macroeconomic inefficiencies persist. And so that's how he sort of reconciled these two ideas. But it was something that I don't think he ever fully came to terms with while he was alive.
I love the great line that he has that I found somewhere, that he thought Amos Hofstadter Sr., who died in a traffic accident in the 70s, he thought he was the greatest trader he had ever seen. I thought that was one of the great lines, just one of those things where if people are paying attention to the details, it shows that a lot of your work, I mean, right there, the fact that Samuelson, was an early proponent and involved in Commodities Corporation, again, that's another foundational jumping off point for your work.
Right.
I want to talk some big picture stuff. People are going to need to go dig in. It's a really interesting read, Adaptive Markets. But I want to talk about big picture here, because the idea of changing the financial culture, how do we make progress? And something that you point out in your work, which I think is really tough for people to accept, is the environment. Speak to when you want to bring people into your world, you want to bring them into the adaptive markets mindset. Speak to environment and the role that it's playing, because it's a really big role.
It is, and I think it's something that economists have not really focused on, and something that I'm hoping to change with the book. The basic idea is actually pretty simple. It goes back to what a biologist or an ecologist would say, and that is that when you start studying a particular ecosystem, you got to understand not only the flora and the fauna, but you have to understand the environment to be able to figure out how all the various different species relate to each other. And sometimes the environment is actually more important than the species that are populating that environment. A case in point is something that the economist/psychologist Herbert Simon proposed years ago. He once observed an ant crawling across a beach. This ant had the most intricate path that took it around puddles of water and across logs and underneath rocks. It seemed like the ant was navigating in an incredibly sophisticated way across an extraordinarily complex terrain. Simon asked the question, how does an ant with very, very little cognitive skills, certainly something that we would take for granted as inconsequential relative to mammals, how does an ant engage in such complicated motion? It finally dawned on him that it's not the ant's motion that's complicated. Rather, the complexity of the path is really a reflection of the environment. The ant may actually have some very simple rules, like if you run into an object, then turn around or go left, and then next time go right. It's really the environment that dictates the complexity of that kind of behavior. And so when we start thinking about individuals engaging in all sorts of very complex behaviors in the stock market, we have to stop and ask, is it something intrinsic about the individual, or is it really the environment that is causing that kind of complex behavior? The example that I give to investors is this notion of investing for stocks in the long run. We all tell investors that they should be long-term investors, that they should hold on to stocks for the long run and not worry about these kind of short-term fluctuations. That may be good advice, but frankly, that's just not credible, because when the market drops by 50%, as it did between 2008 fourth quarter and 2009 first quarter, when you see your 401k turn into a 201k, you are going to react. And the reaction is going to be freaking out. And what that means is that you can't be a long-term investor if you're worried that the short run is going to kill you first. That kind of market environment suggests that the kind of investment strategies that we propose investors follow, they're simply not realistic. They don't take into account the fact that investors are going to react, and that means that the environment is going to have an indelible impact on their long-term wealth accumulation policies.
There's a great line from Buffett where he says, if you can't afford to lose 50% in the markets, you shouldn't be in the markets. And I've been asking people recently, say, hey, where are you right now? What's your situation? Are you kind of passive index? Are you basically long only? And I said, can you imagine how you would feel if your current stock holdings, assuming you're in long only, all-time highs, can you imagine how you would feel if you saw a 50% decline or a 60% decline, or even going back to the 1999-2000 time period, a 77% decline in the NASDAQ? I don't know. I really, it's funny, even after March of 2009, it was such a quick kind of 6-month period, and then things got back to rock and roll. I don't know how people would react if all of a sudden the S&P was back at 1999 levels.
Well, I think that how they react is they freak out. And so this freak out factor is really what drives a lot of market dynamics. And the sooner we can start modeling those dynamics more explicitly, the sooner we'll have more realistic theories about how markets move.
Let me follow up real quick on one last thing here. You brought up the environment. I think I'd love to get your comment on this as well too. When people, another way to think about the environment would be, okay, what type of particular return can I expect in a given year? Well, the reality is you really can't make that kind of guess. You just don't know. Mm-hmm. And I think there's something to the idea that if you can take what the environment gives you, and if your headspace is such that you're comfortable with what the environment gives you, you've got a leg up. Whereas the example that I just mentioned, people long all-time highs, if they're not even remotely expecting that the environment could give them something that they're, it's just not in the cards. But it's another way to think about the environment. I think it's a positive way to think about it if you can let yourself go there, and you doing your work, of course.
That's right. I think it's a very important point to change the mindset from thinking that the market is a kind of a machine that cranks out 6% risk premium year in and year out. I think that's a myth that's been perpetrated by both academics and certain practitioners. Those of us who are in the markets on a regular basis, understand that there is no guarantee that you'll get any kind of risk premium. You can go for 3 or 4 years with a negative risk premium. And that's what most investors who don't do this on a full-time basis, that's what they miss. They seem to think that markets behave more like a physical system, like a machine, rather than a biological system. And the sooner they can think more along the lines of an organic, dynamic kind of a ecosystem where sometimes you'll do well and sometimes you'll get eaten, you have to really understand those kind of market dynamics. The sooner they'll be able to develop more profitable investment strategies for wealth accumulation. And it's not even just wealth accumulation, it's really wealth preservation, because it's during those periods of market trauma where you are reacting emotionally that ultimately end up really hurting the investor. It's when the short-run markets don't allow you to be long-term investors.
Hey, Andrew, one last quick follow-up. You mentioned thinking about the economy as a machine. There's this great video, and I'm sure you've seen it, Ray Dalio walking through the economy as a machine on YouTube. And obviously, Ray's had tremendous success. I think probably perhaps the largest hedge fund. When you see that, are we misinterpreting him? Are we taking it wrong? How do you feel when you see that video where he's walking through everything as just a machine? Because it's very different than what you're writing about in adaptive markets.
It is. And I think that there are lots of different views on how markets work, and his is one, and certainly he's had some great success. But then you talk to somebody like Warren Buffett or to Jeff Bezos or Mark Zuckerberg, and they've each made tremendous fortunes in very, very different ways. And so I think what that tells us is that there are many different forms of success, just like when you look at the landscape of the African savanna, you see that you've got zebra and wildebeest and springbok and tigers and lions, and many different species end up coming up with different ways of surviving and thriving in a dynamic environment. I certainly don't doubt that Dalio has developed a very successful formula. The proof is in the pudding, and you can see that from their success. But there are also many other investors that have taken a very different approach and have become equally, if not even more successful. And I think it tells us that there's a richness to the market ecology that we have to appreciate. There's more than one way to skin a cat, and we really need to understand the various different kinds of species that are out there and how we fit into that ecosystem before we can develop a better idea about what our role might be and how we can maximize our chances for long-term survival.
I think people can feel that in our conversation today, and that's really what you've done in your book, is you're basically just opening up Pandora's box and saying, let's all think about this. Let's look at this three-dimensionally. Let's look at this from this perspective. Let's look at it from that perspective. Let's just be transparent about the discussion and try and put our egos checked at the door. I feel like that's where you've tried to go.
It is. And if I'm successful, I think people will actually develop a very different perspective about financial markets. I've written it in such a way that it doesn't require any prior knowledge of finance. It really is meant to capture people's imaginations. For those of us who really are steeped in markets, it will provide some interesting conclusions to many of the questions that were raised. But for others who don't have any experience, I'm hoping that it's going to give them a different view of how financial markets work and how they might think about making investments in that kind of a dynamic ecosystem.
The book, Adaptive Markets, Financial Evolution at the Speed of Thought. Andrew, is there a website that we can send people to check you out, send you a million emails? I don't know. Is there any place where you want to send people to?
There is my Twitter page. They can follow me on Twitter. I do have a research page at MIT, so they can certainly look for me online.
Very easily found. Hey, thank you for taking some time today. It only took me a couple years to track you down, but as I said, I'm quite pleased to finally get you.
Well, thank you very much. It's been a pleasure.
My guest today inspires readers. No doubt about that. He's the author of 17 books, including 5 bestsellers. His very first one, the energy bus. My guest, John Gordon. I can't think of any cooler way to break into the space that John has broken into and dominated than going down the sports direction. I'm not giving away any hints yet, but this is an inspiring story. Inspiring to see John overcome obstacles, to see John push and strive and make it happen. We can all hope like crazy to look at John's work and say, why not us? Why not me? Why not you? Now, before I get into my conversation with John today, one quick reminder. My newest book, Trend Following, How to Make a Fortune in Bull, Bear, and Black Swan Markets, is now available in audiobook. It only took about 2 months extra time. Don't ask why. These things happen. But it's out now. It's 34 plus hours. Give me a break. You can drive across the country listening to that baby. But enough of my book promotion. And on to my guest today. What a fun conversation. I sincerely hope you enjoy the perspective of John Gordon. So, John, listen, back in the day, I had a buddy of mine, and I don't know exactly how he did this, and I think it was for a Florida State-Miami game in Tallahassee. Somehow or another, this guy, knowing how the system worked, he found his way into the pregame speech that Bobby Bowden was giving to the Florida State Seminoles. He's sitting there with the team, the coaches, and Bobby Bowden, and eventually they just look at the guy and they, who the hell is this guy? Get this guy out of here. You, on the other hand, have figured out a more safe way to connect with the college football coaches of America. This is quite the interesting story. And I think where I'd like to really dig into here is partly how that's happened. But you've got such a fantastic client, I guess, would be with the head football coach of Clemson. What an interesting story. And I don't know what the interesting story is, but I know there's something there.
Yeah, it's pretty wild. I mean, I've been working with teams for years, even before Clemson. I say years, 4 or 5 years. I started, my first team was the Jacksonville Jaguars in 2007. Jack Del Rio was the head coach. He read Energy Bus. Mike Smith, who was the defensive coordinator at the time, gave him the book and said, you should have John come and speak. I didn't know Mike Smith, but I had a friend who knew Mike who gave Mike the book. Jack calls up. And I went down to meet with him, very intimidated.
Okay, this is a tough guy, right? I mean,
and a big, large mountain of a man. I had never spoken to a team before, a high school team, college team, and now here I am meeting with Jack Del Rio. I just wrote the Energy Bus, thought I had something that could make a difference, and now I'm sitting across from him, and he's telling me about how the book really impacted him, about the message of positivity and dealing with energy vampires and negative people and so forth. And he said, would you speak to the team? And I boldly said in that moment, I will speak to the team if you have everyone read the book. And he said, you got it. Done. I'll get it for everyone. He wound up getting the book for everyone in the organization, including the janitors, including the food service people. Everyone got a copy of the Energy Bus. And I went and spoke to the team. I was definitely nervous. I mean, at the time, Fred Taylor was on the team. Maurice Jones-Drew was like a rookie. I mean, these were guys who I loved watching play, guys I supported, saw on TV, and now here I am and speaking in front of them.
Completely random.
Yeah, just sharing my talk on, the Energy Bus. I don't think I was even a great speaker then. I definitely wasn't actually, but I was on fire. I got fired up and just started talking about staying positive, dealing with the negativity, don't allow the energy vampires to sabotage you and bring you down. It really resonated with it. And they had a great season. They went 11-5, made the playoffs for the Jaguars. That was a big deal, and beat the Steelers in the first round. Mike Smith then became the head coach of the Atlanta Falcons. He then called me up out of the blue and said, hey, this is Mike Smith, coach of the Falcons. We just met briefly because I think we just shook hands and that was it. He said, I want to do the same thing with the Falcons that you did with the Jaguars. And so I said, sure. So he got the book for everyone. Went to speak to the Falcons. Matt Ryan was a rookie that year. and Mike Smith was a rookie head coach, spoke to the team, and then did that every year for 7 years while he was a coach until he got fired from the Falcons. But then I worked with the Texas Longhorns in 2009, the year they went to the national championship, spoke to them because a coach had a friend on the team, had actually a friend who was an assistant coach. He heard about it, brought me in, then worked with University of Georgia. But then what happened is, coaches started to pass the book along. For some reason, it was a book that resonated with coaches. And then I wrote Training Camp, What the Best Do Better Than Everyone Else, which is my favorite book I've written. It's about the winning habits that separate the best from the rest. So different coaches started reading those books. And then I started getting invited to speak to basketball teams, women's basketball teams, lacrosse teams, women lacrosse teams. And it's been crazy. I could have never anticipated that I would be doing this, but I do love it. I mean, I spoke to the Dodgers this year, the Pittsburgh Pirates, the Oklahoma City Thunder, the Miami Heat, and teams like that now. So it's really because it was just football. Now I'm getting to speak to a lot of NBA and Major League Baseball teams.
You know what's so awesome about it? Not just the content alone; it's the entrepreneurial instinct, smelling it out and getting that, taking that first chance and jumping in, not necessarily planning it at all and just going for it and each iteration that would come along and build on it. That's what's cool about that story.
You just nailed it, because it was just showing up, doing the work, not worrying about failing, just giving everything I had, not knowing if it was going to be good or not, but then get invited back. And sometimes I'm surprised I am invited back, right? But just to do it and then get better and build. Now when I walk in with a team, I know what they need to hear. I know their challenges, and I can see how along this journey I've been prepared for these bigger audiences and so forth.
Okay, let's use a practical example and stay in the sports for right now, because you do have this, and I hope I don't say it wrong. It's Dabo Swinney, right?
Dabo Swinney. Yeah, Dabo Swinney.
Okay, it looks like you want to say Swinney, but it's Swinney. He loses, his team loses the 2015 national championship 2 years ago. They win it this year. You were involved over the course of the loss and the win?
Yeah, I was brought there to speak 5 years ago. So I've been speaking to the team for the past 5 years. And what happened was Chad Morris read my book, Training Camp. I didn't even know Chad Morris, and he was at Tulsa at the time, hired by Dabo as the offensive coordinator for Clemson. He goes there, gives Dabo the book. This is how weird this stuff happens. Gives him the book. Dabo reads it, loves it. He starts sharing one of the 11 traits of what the best do better than everyone else. He's like, Clemson's going to be the best. And every week he shared one of those characteristics every week with the team for 11 weeks. He was sharing what the best do better. Now, I don't even know he's doing that, but every time I turn on the TV where I live in Florida, the Clemson games seem to be on the ACC network or whatever. I'm going through the channels, and there's Clemson. There's Clemson. I'm watching these guys going, I love these guys. I love this team. Next thing you know, at the end of the season, they had a good season that year. They won 10 games. The year before, they were 6-7, won 10 games. I get a private message on Twitter from Chad Morris, and he said, hey, would you ever come speak to the team? We used your book this year. I'm like, no way. I've been watching you guys all the time. I love your team. And I never loved Clemson before in my life. And so I went and spoke to the team 2012, and I've worked with the team ever since. So yes, I was there in the locker room when they lost the championship, and I saw Dabo give an incredible display of positive leadership, because he didn't focus on the loss. He said, guys, I've never been more proud of you, of a group of men, than I am tonight. You guys are amazing. I wouldn't want to coach any other team. You seniors, you've left a legacy, but you underclassmen, get ready, because we're coming back. And he proceeded to talk for about 5 to 10 minutes about how they were going to come back. They just lost the national championship, and he was already pointing towards the future. I was blown away.
I could very easily think, and you're going to have to educate me because I don't know the backstory, that perhaps you were able to give some piece of insight that helped after a big loss over the course of the next year, coming into where just recently in this, 5-6 months ago, where they actually won it. But now, if I go that direction, I can also very easily think that even the time they lost it, They could have won it, but not for a coin flip almost. I mean, it was literally the luck of the draw. I mean, and also when they won it, the game was so close. So you literally could have been reversed. They could have won the first one and lost the second one. But was there some growth there, or was there something you were able to do to help? Tell me your view on it.
Yeah, I take full credit for all their success. That's my view. No, I'm just kidding. I'm totally kidding, because I believe the complete opposite. It's funny because I spoke to Clemson, and then I also joke when I speak to audiences, because I say, guys, not everyone I talk to wins. I spoke to the Cleveland Browns 2 years ago. So one thing I've learned about is it's never the talk. It's never the book. It's always the leadership. It's always the leaders on the team, the leadership in the coaching room, how they lead, how they deal with adversity, how they come together as a team. Dabo Swinney helped this team grow from that loss. He's an amazing positive leader. I think there's very few things that I said that made a difference. I know training camp, being a part of their program, was helpful. I know that teaching the coaches and team about loving, serving, and caring from the carpenter was very helpful. Dabo talked about that. He talked about his one word for the year. I did that with the team, about having your one word and using that word to have more motivation and purpose. But Dabo had them do a vision board, each guy. They also had a lot of leaders after that loss that came back and said, you know what, we want to win another one. So they really had a lot of great leadership and team accountability. And then you have Deshaun Watson, who is the best quarterback in the country, the best gamer and a great winner, making that last drive. If he doesn't do that last drive, they don't win. So you're right. It could have been all these little things. So everyone looks at it after the fact, but it was a lot of combination of a lot of things. But the two biggest components, no doubt, were the vision that Dabo had, and the leadership and the belief in the players. And then the belief they had each other that, you know what, yes, they just scored with 2 minutes left, but we're coming down and we're winning this game. And they just had this incredible faith and belief in that moment.
Before I dig into some of the principles and ideals in your newest work, The Power of Positive Leadership, one more football type question, sports team type question. You've given some idea of the coaches and your connection with the coaches, but very often the coaches will know of you first, right? And they will then tell the team, hey, you got to know about this guy, John. I'm sure these are stud athletes. You know, they're probably thinking, oh man, some of them are thinking this, hey, whatever. I want you, if you can, are there any names or any players, I don't care the sport, that you can think of when you walked in the room and perhaps they were a little skeptical, and you gave one of those aha moments where they just paused, looked at you, and you knew you had won over a diehard skeptic? Does anything jump to your mind for any of the players in particular?
Well, I mean, I can't really talk about that from a personal standpoint. All I can say is that...
Describe a player without a name.
all I can say is that, when you speak to Oklahoma City Thunder and the Dodgers and the Miami Heat and the Padres and the Pirates, and you have Matt Ryan, the superstars, you have to win them over. Yeah, you're right. So regardless of who's in the room, and even if the coach endorses me, there's some credibility because the coach is saying, hey, I brought this guy here, so there's some value there. Chip Kelly even brought me to the Eagles, and Tim Tebow was there, and Mark Sanchez, and a couple guys were there. And Tim came over to me afterwards. I knew I wanted Tim over because he invited me to a Bible study afterwards. So that was pretty cool, and had a great talk with Tim after that. Really enjoyed our conversation. A great guy. So maybe that's something I can point to. But I do know that you have to win them over. You have to provide something of value that's going to make them better, that's going to help them grow. And if you can't, they're going to tune you out, and they're going to tell right away if you're full of it. And they're going to know if you're the real deal or not. So to me, again, I've had guys reach out to me after the fact, text me, have begun conversations. I'm there to encourage them and help them. And those are the kind of things that come from those talks. Not everyone. Some guys might be rolling their eyes. There are always going to be a few probably. But for probably 90% of the guys, buy in. There's maybe 25% that really buy in and they want to keep in touch with you. And that's something. And again, I don't charge these guys. It's just something that they'll reach out. I'll reach out, encourage them, and keep a dialogue. That's why, again, they're so private that I really can't share who, and I don't want to violate that trust.
Let's dig into positive leadership. Now, people might hear that phrase immediately, positive leadership. They might think to themselves, well, come on, all leaders are positive. I mean, but that's not the case. And I can think of an example, and I will try not to name names here, but there's a big ride sharing company, and the CEO seems to get mixed up in every bad headline in the world. And it doesn't seem very positive to me. But for the audience right now, for those that are hearing of you for the first time, why don't you lay out for us positive leadership, big picture, macro?
Sure, and I'm glad we're moving into this because I don't just work with sports teams. I do work with a lot of companies and, leaders of Fortune 500 companies. And it's funny because I actually do more of that than sports. Sports are just what people seem to love to talk about. But in terms of, positive leadership, to be a leader, a real and effective leader, you must be a positive leader. We almost shouldn't have to say positive, right? Because you have to be optimistic if you are a leader. You have to believe in a brighter and better future because that's what leaders do. They point people towards the future. You could be a visionary. Steve Jobs maybe wasn't positive, so to speak, in terms of his relationships, but he was very positive about creating a future that he imagined, that he believed in, the culture, and also what they called his reality distortion field, that time and time again, he was able to distort the reality of his employees because they said there's no way they can create the software in a certain amount of time, and he would always convince them they can do it faster. And they said time and time again, he distorted their reality from, some would say, pessimism or realism, I'm just being a realist, to optimism. And that's what positive leaders do. So first and foremost, they're very big on vision. They see a brighter and better future. They lead with this optimism and belief that it's possible, right? We can do this. And then they also, though, deal with the negativity that exists. They don't allow negativity to sabotage their team. So that's something I wrote about, again, in this book and create a framework in terms of you got to address negativity. One of the biggest mistakes that leaders make is they don't address negativity. So being a positive leader is not about Pollyanna positive. It's not about thinking we're going to sing Kumbaya and hold hands all the time. So no, we got some real issues. We got some real challenges. We will address them. We will deal with the negativity, but we're going to do so in a positive way. And as we do so in a positive way, we then create a fertile environment now where we weed the negative, feed the positive, create an environment where everyone can do their best work. And then positive leaders do what they really do is they unite the organization. They unite people. They rally people. Alan Mulally, which I wrote about and that is a great example in the book. And then they also connect with individuals. They develop the relationship. So this guy you're talking about, the rideshare company, he's very big on vision, right? Excellent on getting a product to market, but I'm not sure I would describe him as a full-blown positive leader in terms of how he really approaches people and things, just as Steve Jobs maybe wasn't the complete positive leader.
Positivity, though, is contagious. And that might sound to some people hokey or something, but if you have a positive leader at the top who's pushing that positivity nonstop, 24/7, it does rewire the circuits of those underneath him, doesn't it?
It does. And you're right. It is contagious in a positive way. And the research shows this to be true that our feelings transmitted by the heart are contagious. So you're broadcasting positive energy or negative energy. We also have research that shows that emotions are contagious, emotional contagions. So people are likely to catch your good mood just as they might catch your bad mood. That's important to know as a leader, that you are contagious in that way. And so when you come in with this vision and your feelings and your emotions and your beliefs, those are contagious to the people around you. Leadership, I often say, is a transfer of belief. When Dabo Swinney got the job at Clemson, he walked in the office, walked in the team meeting room, and he brought in two signs. One that said believe and I can't with the T crossed out. And he built that program based on belief, saw firsthand how contagious it is. And people start to get the mission. They start to get the vision. They start to buy into the belief from that leader. And so you see it all the time in businesses. You see it in companies, in schools. You want to transform a school? Everyone's talking about transforming education. Bring in a positive leader as a principal, someone who can really rally the teachers, who gets them involved, gets them bought into what they're doing, get them involved in the mission of making a difference in kids' lives. You do that one school at a time, bring in a great leader, you're going to transform the school.
Let me use Dabo as an example here, just since you mentioned him again. It wasn't that he got the job and walked into the room and everyone automatically followed him. It wasn't because he mandated, you must follow me, I am the hired leader. This positive leadership it's the people underneath the leader want to follow. It's not just, you can't command it. You have to become that someone that, the people underneath you want to be like you. They want to be with you.
Yeah, I love the way you just said that, because it's not something you can dictate. The dictatorial leader no longer works today. You have to be someone that they want to follow. And you have to, as Walt Whitman said, convince by your presence. And so through your positive energy, through your belief, you're convincing. Now, let's get something straight here, by the way, though. People are probably thinking, does this mean I have to be an extrovert? No, you can be an introvert and still be a positive leader. Your energy is still contagious. The love that you have, the passion or the mission that you're driven by internally is what people sense, is what they feel. Your integrity is contagious. So ultimately who you are is what people are picking up on every day and every moment. So that's what people need to know in terms of this leadership that truly makes a difference.
I liked this phrase that I had never heard before in the power of positive leadership, which is the caring trademark. And I'm going to paraphrase here, but you describe it as kind of that unique way to show that you care. What is that? What is that something? I care. I love doing this podcast. I'm at 500 plus episodes. I love writing books. I love doing these things. I don't know exactly what it is or what I put into it, but I think you can. If people stop paying attention, they know you don't care. I think if you do give it your all, but I was trying to think of that. I was like, wow, a caring trademark. That's really an interesting concept. Speak to it. And you're right, how that came to you, and perhaps an example that you could help illustrate with the audience.
Yeah, I started to think about, like, every great leader and company does have a caring trademark. If you go to Publix supermarkets, have you ever been to a Publix?
Down in the South, I have.
Okay, and if you ask someone who works there where something is, they're not allowed to just tell you. They have to walk you to the spot on the shelf and show you where it is. They're not allowed to say, aisle 9, good luck, man. They have to take you to the spot. So that's their care and trademark. They're known for that. Les Schwab Tire Centers in Oregon, when you pull up, they actually sprint outside from inside to greet you when you get out of your car at the tire centers. That's their care and trademark. I started to think of Chick-fil-A, which says my pleasure, not no problem. They say my pleasure. That's one of their care and trademarks. And so people have them as well. Dabo, for instance, he believes in his players more than they believe in themselves. Clint Hurdle, the coach of the Pirates, the manager of the Pirates, he's just a guy who just loves his players like family. And they just know it. Some coaches like Mike Smith, he's a great listener. Like, that's his care and trademark. He truly listens, and his players know that he's always there for them with a listening ear. My care and trademark is encouragement. I love to encourage people. And so I know that anyone who reaches out to me, for instance, needs encouragement. I always respond because I want to encourage people. So that's my care and trademark. Derek Jeter with the Yankees, his last at bat was so special. It was a game-winning hit, right, in Yankee Stadium. But it was so special because he ran to first base every time, whether it was an out or a home run, like it was his last at-bat. Every at-bat he treated like his last. So he showed he cared. Doug Conan, former CEO of Campbell's Soup, he has written over 10,000 thank you notes to people he's done business with and to his employees of Campbell's Soup at the time. So that was his care and trademark, is to write these thank you notes. Amazing. If you don't know what it is, I really believe you can discover it. And I believe your podcast, obviously, is one of the ways that you show you care. But here's the thing. We could tell when someone cares or not, right? We know when they care. They put their heart and soul and spirit and passion into it. I wrote about this in The Carpenter. There's a difference between a carpenter and a craftsman. Carpenter shows up and just builds something. But the craftsman or the craftswoman, they put their heart and soul and spirit and passion into what they're building. Why? Because they care more.
Now, look, anyone listening to you right now can feel the energy. They can feel the passion. And, of course, to go in and deal with corporate America and sports teams, you have to give that too. But I think, and I'm not mistaken here, I don't think I'm mistaken, I've seen you described, and maybe this was a self-description, a 31-year-old, fearful, negative, stressed out guy. Is that accurate?
That was then, yeah. Now I'm 46, so that was a while ago.
So what was going on at 31? What was I mean, obviously you're not there now, but it can be helpful for people to see. I mean, you describe yourself fearful, negative, stressed out at age 31. What changed for you?
What changed was that my wife gave me the ultimatum, like, okay, change or you're off the bus. She really said, if you don't change, I'm leaving. So you better change. And I begged her to stay, agreed to change, and that began my journey.
How did you take the first step?
The first step was literally a prayer. And I never really prayed before like this. I just said, God, like I reached out and cried out, like, why am I here? I know some people don't believe in God, but I was like, you know what? God, I know you're out there. I am miserable. I'm negative. Why am I here? I know I'm here for a reason. What is it? And I kid you not, writing and speaking came to me in that moment. It was a divine experience. I mean, it wasn't like a lightning strike or anything, but it was just like this came to me and I'm like, okay. And I had this feel like that's what I'm going to do.
That aha moment.
Yeah, like what am I going to write about? I don't know, but I'm going to do it. That's what I'm going to do. Ken Blanchard was one of my role models I looked up to. He went to Cornell and taught at Cornell. I went to Cornell. It's funny that he would wind up writing the foreword to The Energy Bus, my first book. I said, okay, I'm gonna write and speak. I didn't know what, but I have a friend to this day. He's the CEO of a company, very successful. He remembers me telling him like one day, like around that time, like, I'm going to write and speak. That's what I'm going to do. And he's like, and you went and did it. And it was just literally, it wasn't success right away, but I just said, that's what I'm going to do. And I began the step, though, of more so changing me more than trying to change the world. It started with me having to become a more positive person. That's why that chapter is called From Negative to Positive, because I had to get out there and become a better me first. So I was like taking walks of gratitude and prayer each day, just saying what I was thankful for, trying to flood my brain and body with positive emotions that uplift me. I started writing different things and sharing these tips. At the time there wasn't newsletters back then. There weren't all these blogs. In 2002 I started a positive tip of the week. I've done it now for 15 years. I write it every week myself, and I still do it every day. Again, got to care, right? Got to care more. Got to continue to do it.
Doing the laundry, so to speak.
Yeah, I still do the laundry, but I didn't do it then, but I do it now. I got to show my wife I care, and so I continue to do these like newsletters every week because that's what I did back then, and I got to continue to show that I do it. But it was like this step by step of doing the newsletter, just starting out there, sending it to 5 people, then 6 people. I then started to say, hey, I'm going to write and speak. I started putting it out there to friends, anyone who wants to talk. I created a web page that just was like a picture, had a news section, and it was just like, this is what I'm doing now. And a friend reached out, said, hey, I have a friend that works for Singular Wireless. This is how long it was. Would you go speak to her team? I did like 80 free talks, 80 free talks just to get started. But it really helped me get better and improve as I did it. And again, I never thought I was going to make money from this. I was just like, you know what? I'm going to go do this and live this life that I'm meant to live and go do what I'm meant to do. And if it makes me successful over time, if it's leads to great things, then great. If not, we'll see what happens, but I'm just going to go for it.
Look, when you can find an insight that other people don't know and pass it along, that feeling alone gives an adrenaline burst that you can't turn off.
Yeah, as a speaker, you know this well, right? When you've made a difference in someone's life, and you write as well, so as you write and speak and you can impact someone, that is the greatest feeling in the world. People always ask, what's the greatest feeling? It's not winning the lottery. I believe it's knowing that you made a difference.
Yeah. Hey, there's a couple bullet point notes that I made here, and I don't know if you've talked to any kind of Wall Street folks yet or have gone that direction, but there's two phrases, and they're not necessarily connected, but embrace failure and trust the process. You might be surprised to know that in great trading, great Wall Street performance, embracing failure, like for example, if a trade goes against you, getting out, taking a loss is like number one. And trusting the process, meaning once you have a system or an approach, you have to stick with it regardless of the minor hiccups along the way, the quote whipsaws. So I don't know if you've thought about this, but I see some of the statements in your book and I'm like, oh my gosh, I kind of have written about this in a completely different audience, but embrace failure, trust the process. Give me your feeling.
Oh, yeah. I mean, this is the same kind of principles for success in sports, on the trading floor, investments. You have to trust the process. You have to say, you know what? These are my strengths. These are my principles for success. You cannot lead or succeed based on circumstance, right? You have to lead and succeed based on your principles. This is how we do things. This is how I handle, because those principles are your rock when circumstances change. Now, it doesn't mean you're not flexible. It's sometimes different circumstances you have to be flexible, but you lead by your principles and your process of how you do things. So the principle side of things is what you're talking about. And then what was the other one? The process and
embracing failure.
Oh, embracing failure. Yeah. So embracing failure is the key to any success. Now, you don't want to have too many failures. You want to learn from your failures, but it's the idea of a growth mindset that along the way, failure is an event. It's not a definition. You cannot be afraid to fail and succeed at the same time. It's an NBA player going for a shot. If you're worried about missing it, you're going to miss it. You got to be willing to go for it, and to truly succeed in trading and investments, you have to be willing, right, to take some risk. It's mitigated risk, but you have to take some risk in order to succeed.
I want to go into a topic, something that you brought up early in the podcast, and some people might not be familiar with the term. They might be able to deduce pretty quickly where you're going, but energy vampire. Give the definition of the energy vampire from the John Gordon perspective.
Well, it's that guy in the locker room, or that teacher in the building, or that person on the trading floor, that person who works in your office that just sucks the life right out of you. They're just a negative person. They're an energy drain. When you finish a conversation with them, you feel exhausted. That is an energy vampire. And one person can't make a team, but one person can break a team. I was speaking to the University of Georgia football team. Mark Richt brought me in to speak. And after I spoke, they lost the first 2 games. I thought I ruined them. He had the entire team read the energy bus. And then after they lost those 2 games, I was like, oh, man. So I sent him a text. I said, Coach, I still believe in you guys. He said, John, the guys are still on the bus. In years past, we've allowed energy vampires to sabotage our team, but not this year. This year, we will not allow it. In their big meeting room, they put a huge picture of an energy vampire on the wall. And anytime one of the players was being a vampire, they took their picture from the media guy, they put it on the wall. No one wanted to be on the wall. They went on to win the next 10 games in a row, making it to the SEC championship. That team truly believes that staying positive really helped them. And a team that stays positive together wins together. And guys were going into his office saying, Coach, I'm not going to be a vampire anymore. I've been one, but I'm not going to be one anymore. And you know what? I go to companies. I've worked with some financial companies. You were mentioning that earlier. I have. And you could see the guys. They just roll in their eyes. They think whatever. They don't need this positivity. You know what? They're not into it. And there's always going to be a few vampires. But I believe to create a great culture, you have to address those vampires. To create a great culture, you can't allow one negative person to sabotage your culture or your team, because if they're bringing everyone else down, that's going to affect performance overall. You see football coaches do it. You see great teams do it. So I'm a big believer in making sure that you address those vampires, try to transform them, try to help them get better, help them improve. If they don't, you got to let them off the bus.
That was going to be my question, really, was the practical effect of dealing with an energy vampire. There's the attempt to transform, but is there a way where the audience, from all the experience you've seen, is there something where people, when you've got an energy vampire and they won't transform, is each situation's different, but are there telltale signs that you've got one that's not going to transform, and the only solution is to part ways?
I think it's going through the process of trying to work with that person, talk to them, coach them, and see if they're willing to change. See if there's a change of heart. See if they're humble enough to say, you know what, I want to get better. And if they're not, because there were guys who are now in the NFL who were on that team at Georgia who literally were transformed by deciding to be positive. And they talk about how it changed their life forever. I know 3 or 4 of them that I still have great relationships with. So if someone's not willing to change, though, Butch Jones came to me at University of Tennessee. He said, John, He spoke to 10 of them, his vampires. 8 stayed on the bus and 2 got off. And he knew that those 2 had to get off. They were unwilling to change. So I believe you go through the process of trying to make a change, trying to impact. If they won't change, then right then and there, you got to let them off. So cool, though. We work with this. We have an Energy Bus for Schools program. We are transforming education through this building positive cultures and positive leaders. Started out with 5 model schools. Now we have 50. We're going on 100. It's unbelievable. The case studies are going to be incredible what's coming out of this. But we had one principal call us, and I have a former principal, and she runs the whole thing, Nikki Spears. And she said, Nikki, she's like, I don't know what to do with this vampire. Should I kick them off the bus? And Nikki said, just work through it, try to transform it, and build your culture so strong that they'll get off themselves. She goes, I don't know if that will ever happen. Well, guess what? The end of the year is happening now. That teacher came to that principal and said, I just can't do this energy bus stuff anymore. I'm resigning. I can't do it anymore. I can't stand it. She couldn't stand the positivity. So she was out and she got off herself.
You know what I love too? This one line here that I jotted down. Don't be negative about negativity, which kind of treats it like an isolated cancer. This is my wording, but don't be negative about the negativity, meaning you can spot it, you can attempt to deal with it, but don't let it affect you. Just let it be something compartmentalized. Am I reading you right?
I had to write that in the Power of Positive Leadership because it's been 10 years since the energy bus has been out. Many people are discovering it for the first time, but the people that have used it, over the years, some have misused it. So what they do is they say, you're either on my bus or off my bus, and that's their leadership. And it was never meant to be that way. So I have people literally emailing me saying, John, we're reading your book. My boss, though, is the biggest energy vampire of all, and they're trying to promote this like it's part of the plan, part of the program. It's really hard to get those kind of emails because that was never intended to be like that. So I wrote this to say, you know what? You may have negativity, but you don't address it in a negative way. You don't be negative in that way. You have to, through great leadership, through relationships, what we talked about earlier, belief and vision and being positively contagious. Get those people on your bus by the way you lead. If they don't, then you let them off. But don't come in with this negativity thinking it's positive.
One last one for you, John. I think it's a really important one for any personal success, any team success. There's been some books written about it, but I would love for your perspective as well. And that's grit, persistence, grit. I mean, it's like the starting point. You've got to have it. You've got to believe. You just got to stick with it no matter what.
Yeah, Angela Duckworth, foremost researcher on grit, just wrote a great book called Grit, came out. We had a conversation before her book was coming out, and I told her my thoughts on grit, asked her, were they in alignment with her research? She said yes. So I knew I was on the right track. And the key here is that, as she says, grit is the number one predictor and factor of success. And every leader to succeed, as we know, will have to have grit because you're going to face adversity. You'll face challenges, the energy vampires, the naysayers. Steve Jobs was fired. Oprah was told she wasn't good enough. Elon Musk went through all the challenges, right, that he had to go through to build his companies. Everyone who has this leadership opportunity will overcome challenges on their journey. So it's the grit that continues to push you forward to be successful in the long run.
John, why is this perspective that you have, why is this not thrown out to freshmen in high school, freshmen in college? Why do we go these other directions that sometimes seem to be more of the pretend world and the real world is kept away from students? It's a long answer, I know, but I hear you and I'm just like, gosh, this should be indoctrination. This is like 101.
I appreciate it. And that's my hope. I mean, in writing this book, it's only been out for maybe a month now. So I believe that I wrote this book. My mission and passion in writing this book was that it's going to be the standard of what positive leadership is about. Not Pollyanna, grounded in reality, based on research, and with hope and vision, optimism, and practical ways to lead, that this will be what we will teach high school kids, college kids in business schools. That's why I combine real business examples, real coaches, real examples, a framework that we can use, create an action plan to go with it. And now I'm working on an assessment that a leader could actually take to see where they stand, and then a 360 assessment where a leader will give to their team and say, how am I doing? Am I really a positive leader like I think I am? Because we get all these leaders that think they're positive and they're not. And I also want a team to be able to say to their leader, hey, can we do this assessment with you? And see if the leader will be okay with that. So I want to transform leadership and get all those horrible leaders that are really destroying cultures, ruining their teams, leading the wrong way. I want to transform those people to be more positive leaders, because if they can lead better, we will have much better people, much better offices, much better buildings, companies, and really, I believe it will change the world in the long run.
John, you're infectious. Good stuff. The new book, The Power of Positive Leadership: How and Why Positive Leaders Transform Teams and Organizations and Change the World. John Gordon. John, I appreciate you taking some time today. Great insight. Sounds like a really fun life you've developed. I'm quite envious. I love the sports connection. Awesome.
Thanks, Mike. No, I've had a blast, and it's been a lot of fun, a lot of grit, and a lot of adversity, and a lot of pain along the way. But I am enjoying it now.
Where's the best website we can send people to, John?
It's johngordon.com, Jon Gordon.com, and Twitter at JONGordon11.
John, I appreciate your time today.
Mike, thanks so much. You're awesome. I really appreciate it.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.